The vast majority of investing literature and discussion deals with what to buy or which investments will have the best returns. Of course, security or fund selection is important, but what about how to size those investments? Or in other words, how best to allocate the capital among the investments in your portfolio? It turns out that many investors don't use an adequate framework to address that question. So much so that even portfolios consisting of investments with high probabilities of success can yield surprisingly poor results. Take, for example, the experiment done by Victor Haghani and Richard Dewey, in which they gave a large group of individuals with finance backgrounds the opportunity to bet real money on a virtual coin flip. It was programmed to land 60% of the time on heads and 40% on tails. Sounds like pretty good odds, right? The subjects were given $25 and a half hour to bet on the coin flips with an opportunity to earn up to $250. While predictive modeling suggests that nearly everyone should have theoretically earned the maximum payout if they had a proper, consistent sizing or allocation framework, only 21% of participants actually did receive the highest return. More disappointingly, 1/3 of participants lost money, with 28% having gone bust and received no payout. Think about that. With great odds, they still lost money because their sizing was wrong. Sizing can be a problem in fund investing as well. Morningstar estimates that investors have underperformed the mutual funds and ETFs in which they've invested by more than 170 basis points annually over the past decade. Much of this underperformance is due to investors buying or increasing positions after strong performance, or vice versa. However, Morningstar estimates that dollar cost averaging, or investing a fixed amount on a regular basis such that more shares are purchased as an investment declines in value and fewer shares are purchased as the investment appreciates, would have greatly improved the results. At Alger, we believe the lesson here is that extending a disciplined sizing or allocation framework beyond the typical selection process may go a long way in limiting behavioral errors and capitalizing on fundamentally favorable investments.